Hello everyone, wish you all a very happy 2019. 2018 from an investing standpoint was literally an andhadhun year, given the kind of roller coasters that we witnessed across asset classes, including fixed income and equities. Bond market investors had literally raised down their expectations to zero, given the fact that we had seen the bond yields rise non-cessantly till about 3 to 4 months back. Fortunately, they did not need a sui dhaga to stitch the bond portfolios as the bond yields started receding towards the fag end of 2018. What really caused this was a confluence of A, crude oil prices coming off from the threatening $100 a barrel level to right now at about $55 to $60 a barrel. Second, we saw inflation expectations and the main print on the CPI inflation come on the lower end, which prompted the Reserve Bank of India to lower its targets for FY20 first half as also the remainder of FY19. Given a confluence of all this, as also the global yields, specifically the US yields coming off, we saw a reasonably good end to 2018. On the liquidity front, the markets continue to grapple with higher deficit on the liquidity front. However, the silver lining has been the open market bond purchases by Reserve Bank of India, which has helped reduce the liquidity deficit to a large extent. The short end of the bond yields, therefore, have been mimicking the response to the RBI open market bond purchases. We are likely to see a continued purchase of bonds from the Reserve Bank of India to ensure that the liquidity in the system is not impacted materially. With that, we expect the current yield curve to remain reasonably anchored at the current levels. Market participants which were talking about rate hike, at least 2 more in FY19, are now being prompted to start talking about rate cuts in early part of 2019. Such has been the V-turn in the sentiment for bond market investors. It is rightly so, given that the US, which is the mother of all economies, is actually not racing towards growth, but actually limping towards growth. Given that and the US bond yields cooling off, we expect anchoring of the Indian bond yields at the current levels. Foreign portfolio investors have been net sellers for 2018, which is the second highest after 2013 in terms of negative sales. However, in the month of November and December 2018, they continued to be net buyers to the tune of a combined 13,000 crores or approximately $2 billion. It remains to be seen how the FPIs will behave in 2019 given an election year, given there is a change of guard at the Reserve Bank of India, as also the fact that crude oil is now seeming to stabilize at the current levels. However, we are hopeful that 2019 will be less andhadhun compared to what 2018 was. Volatility is likely to be the order of the day. However, from bond market investors' standpoint, considering strategies like short-term and also credit risk funds could be the way to go going forward. Also, funds on the long side or medium side with overweight on corporate bonds, to our mind, could be a better suited strategy, given that in the current rally, we've hardly seen corporate bonds performing well. The government bond yields are at about 7.4%, and assuming current repo rate or maybe a 25 basis rate cut over the next 2 quarters, if that starts getting baked into the current yields, we could see the bond yields heading a little bit lower. But sustainability, as I said, is contingent on crude oil prices and also what could be the next move from Reserve Bank of India. For now, it is important to have loads of patience and, more importantly, discipline while making allocations into the market. We are hopeful that we are able to ride through volatility the same way that we managed money for you in 2018. It is important to keep the faith and have trust. Once again, wish you and your family a very happy 2019. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.